Listening to a big CNBC TV18 exclusive, Nimesh Shah caught up with a rarely heard but much valued voice, Sakthi Siva, the head of Asia Pacific Equity Strategy at Credit Suisse, on the sidelines of their 20th annual Asia Investment Conference in Hong Kong. He began by asking her why they are underweight on India now. Listen in.
Our theme for the region is actually the best RoE fundamentals in 6 years.
Correct.
And India actually does have improving RoE. So we are constructive on India from an RoE perspective. But the reason for our caution and the reason for our underweight in India is we think a lot of this is already priced in.
Okay.
So if you look at India, RoE has actually risen by about 1 to 2 percentage points from the low. And that's, as I said, our theme for the year. But unfortunately, what we think is already being priced in is something like a 19% recovery in RoE.
Okay.
So I want to emphasize, it's really a valuation call.
Okay.
So it's not that we don't agree with the RoE improvement and whatever else.
Sure.
It is very much a valuation call.
Okay. So while everybody debates that valuation for India at 17, 18 times forward earnings looks expensive, but the flip side to this is there is an argument that the earnings are going to pick up in the second half of this financial year. Is that something which you are of doubt that earnings will not actually come up for India?
Actually, we actually think earnings will improve.
Okay.
But our argument is actually earnings are improving across the region as well.
Sure.
Right? And there are markets that are not pricing in as much of an improvement in earnings. Okay. So if we look at the Asia Pacific region as a whole, the consensus is now picked up to about 15% earnings growth for the region.
Sure.
Right? Remember, for the last 3 years, earnings have only averaged around 2%.
Correct.
So 15 is a huge improvement. And the last time we had double-digit earnings growth was back in 2010. So again, it's not that we are not positive on Indian earnings.
Okay.
It's just that we think that a lot of other markets are also seeing improvement in earnings.
Sure.
So India's RoE is rising, but so is Korea's RoE.
Okay.
So is RoE in Australia, Taiwan, and even if we look at MSCI China, if you exclude the financials, RoE is also starting to pick up.
Okay. So the big sector call or the big call that I read in a report of late is that you are looking to advise clients to buy the cyclicals, especially in Asia. What's the view there, and probably what are the key themes that you think investors should look at?
Yeah, we're still keen on cyclicals. A lot of clients have been worried that the rally in the cyclicals has been quite a lot. Has been quite large. Cyclicals have outperformed defensives by over 20% over the last 18 months. So some clients are saying maybe there's a lot of optimism about Trump and his policies already being baked into the cyclical prices. Our argument is that if you feel the cyclicals have run hard, instead of buying defensives, maybe look at a switch from some of the North Asian cyclicals, which have done particularly well, towards some of the ASEAN cyclicals, which have actually been kind of laggards. So if you look at North Asia, cyclicals have actually outperformed defensives by as much as 35%.
Okay.
In ASEAN, the outperformance is only around 10%.
Okay.
So in December last year, one of the big changes we did was to take a little bit of what we call profits in some of the tech stocks. We're still overweight, but we took a bit of profits in some of the North Asian tech stocks. And we've actually been adding some ASEAN cyclicals, which haven't done at least as well as the North Asian ones.
Okay. What on the Trump policies and the global markets? Because last year we saw two unprecedented events in terms of Brexit, in terms of Trump victory, and still the global markets have rallied pretty hard. In that context, how are you mapping up the global setup, and what this could mean for emerging markets like India?
Okay. I mean, I still consider Trump, as I said, a major risk factor.
Okay.
Obviously, the border tax, which we have heard a lot about, is a source of concern. But we are also saying on the other side, as I said, domestic fundamentals. And our view is what drives markets is actually RoE, or return on equity. And in our view, this is the best RoE fundamentals in 6 years. For 6 years, RoE in Asia-Pac has been coming down. And we're now seeing the first signs of what we call an inflection or a turning point. So we are kind of trying to advise investors that if we get a pullback because of Trump's policy, whether it's a border tax, a tariff, or protectionism, that also focus on the fact that it could be a buying opportunity, given that we are seeing this inflection point. And as an APEC strategist, I've been waiting for 6 years to see this inflection point. So we are highlighting best earnings growth since 2010, first pickup in RoE since 2010, And the other real surprise has been this year we're starting the year with earnings upgrades.
Okay.
Again, that's the last time we saw that was 2010.
Okay. Even last time when I met you at this conference and we spoke about the markets and all, the one big thing that you had that in time was the global some sort of global commodity cycles and the commodity plays. I guess one of the big call last year for you in that model portfolio is Hindalco, and that's actually given 4x returns in the last 1 year itself. From a global commodities point of view, what's your view there? And you think there's still money to be made in some of the global commodity plays?
I mean, the commodity stocks have done very well. So, potentially going forward, the upside may not be as large as last year. So we have been a bit more kind of saying, buy the pullbacks, buy the dips rather than just buy the cyclicals. But our argument on commodities and the reason we like commodity stocks was not actually because of Trump. If you remember last year, my argument was that we are seeing supply cuts. So our argument has not been focused on demand rising. Our focus has always been that because of pollution and because of policy and because of, I guess, funding, China is actually kind of cutting back on supply. So we are still of that view. So we are, again, happy to be buyers of the dips.
Okay. The big call from the whole Credit Suisse house, whether it's Nilco and whether it's you all predicted the big slowdown in terms of supply from China, and that actually helped a lot of the commodity stocks. In fact, Nilco tracks the commodity stocks very closely. He's been bang on as far as calls in the Indian commodity stocks. But the other interesting part of your report was that typically you've seen when Fed rate hikes, it actually helps the emerging market in terms of sentiment and in terms of flows as well. We can just explain that rationale to us.
Okay. I think the question is you need to break up the Fed hike actually into what I call 3 phases actually.
Okay.
So going into the Fed hike is actually not positive for emerging markets.
Okay.
We tend to normally see a correction in markets going into the Fed hike, and if you recall, going into the first hike in December of 2015, we did get a correction. So the first part I always say it is kind of there is a correction, but we should buy the dip.
Okay.
Then there is a second phase when the Fed hikes, which is when we call it the real Fed funds rate is actually negative.
Okay.
So this is when policy is accommodative and becoming less accommodative.
Okay.
This is the period where I think is actually very good for emerging markets, and this is the period that we are currently in.
Okay, well, the strong pre-open rates, and as expected, it's the